When it comes to money and investment decisions, seeking advice is quite common, whether it is from your neighbor or the veteran stock picker. I think that has to do with the need for validation. You want to know what you're doing is right, and you want someone else to tell you that it is. But often people tend to run after bad advice instead of listening to the words that they need to. And that's not a new concept. Poet Saint Kabir has written a number of couplets or dohas about a variety of things, and one of them has to do with this. He says, people aren't interested in the truth. Rather, they fall prey to all the tall claims out there. It's akin to the milk seller who has to walk down the streets to sell something that is good for you, while the alcohol seller can sit comfortably with everyone flocking to him. It doesn't sound as beautiful as it does in Kabir's words. This is Moneywise, and I'm Alex Matthew. And on this episode, my guest brings you Kabir's wisdom and also Rahim's wisdom and how that can relate to your financial decision making. Vinayak Sapre, who's a financial coach and author, is joining me now.
Hi.
Vinayak, thanks so much for taking the time.
Thank you so much, Alex.
Like
for
I
having
said,
me here.
I paraphrased, and I paraphrased heavily. Let me hear the actual words.
Okay, so Kabir says that "Sache koi na pati jai, jhoote jagpati aaye." Means people are not interested in the truth. Jhoote jagpati aaye. So they are more interested in somebody who is talking more exciting things. Gali gali goras fire, madira baithi bikaye. It's akin to that the milkman, as you said, he's walking down the street to sell milk, whereas the alcohol seller, people are flocking on to the alcohol shop to buy the alcohol.
It's so beautiful, right? And you've read Kabir's work extensively, Rahim's work extensively. You've even written a book about it.
Yes.
It's called Doha-nomics.
Yeah.
And you've tried to get that wisdom and pass it on to people and tell them that even their financial decision making can benefit from this wisdom.
True.
What drew you to that? Is this something that you looked at much earlier in your life and you said that this is relevant?
Yes. So one is I'm born and brought up in Varanasi, so Kabir is in the blood.
Okay.
Secondly, since I have spent enough number of years in financial services, and what I realized during that period, especially whilst working with AMC, is that the communication was an issue. The concept of mutual funds or the concept of personal finance is a fantastic thing, but the way we have been communicating with people, to the laymen, the investors who need these concepts, the communication was an issue because it was very jargonized. I thought I need to simplify it. I need to Indianize it. And I need to change it into the language people understand the best. And that's where the idea of reaching out to Sant, Kabir and Rahim got into my head. And I said, a large portion of the country, as in a big chunk, the population of the country, they have read Kabir and Rahim in their school days. And the beauty of these duhas, because both these saints, they were great observants. What was happening in this society, and they kind of gave the message that how to conduct yourself in daily life. And I thought that the messages are can be linked to the investment, because as the psychologists also say, the behavioral economics also suggests that people make money or lose money largely because of their behavior with the money.
Yes.
So how do you behave with your money? That will decide whether you will become a successful investor or happy investor or not.
So the reason why I chose to start with that, and we were speaking before today, and the reason why we're doing this today is because I was so taken by what you were describing that I thought that my viewers would also benefit from it. But we're speaking at a time when, if you look at the Nifty 50, just as an indication of how the market has done over the last several years, then if you look at a little over 400 days now, and you do a point to point and you calculate the change, it's pretty much flat. So a lot of people that got advice to go whole hog into equities and went into the broader markets and invested in sectoral and thematic funds, they're seeing now some of that bad advice come into play. How much of this is setting your expectations and then sticking to it?
Yeah, very important question. Thanks for asking this. What has happened is, in fact, in last 10, 15 years, we can divide into two parts. That is pre-pandemic era and post-pandemic era. What has happened is, post-pandemic, all of a sudden the market started going up, and during that period, people who came into the market, they made humongous return.
Yes.
Much more than what they would have otherwise expected. And that's where people start thinking that they have become expert and they can generate these kind of returns. But the fact is, such as returns are not sustainable. Secondly, if you are coming with the thought that stock market will never go down, people need to understand that it goes through a lot of volatility. Market is supposed to be volatile in nature. And why only 400 days? In the past, we have seen market has given negative returns for 3 years also.
Yes.
And that's where if you set the expectations right from the day one, that the expectation has to be rational in nature. So when the market goes down, you don't feel bad or you don't get jittery. And that's why Rahim says that, and you don't need to take too much of action. What happens is, when market starts going down, people start moving out. It should be other way around. That when the market is going down, that's a good time to buy, not to exit.
Yeah.
Right. So that's where Rahim says that. So my point as a market expert or an observer of the market, I can say that if you can't buy that at that point in time when the market is falling, but you need to stay calm.
Okay, so, but what does Rahim say?
So Rahim says, रहीमन चुप हवे बैठिए देखी दिनन को फिर जब नीके दिन आई है बनत न लगी है देर.
Okay.
So you don't need to take action on everything because like stock market, life is also it goes through lots of ups and downs. You need to observe what is happening. You don't need to take too much of action.
So let's take it line by line for those people that aren't well versed with the language.
So Rahiman chup have बैठिए. It means stay calm, stay put. Don't do anything. देखी दिनन को फिर. So keep watching, keep observing what is happening. Don't feel anxious, don't get jittery. जब नीके दिन आई है, नीके means अच्छे, good. So when the good days will come, बनत न लगी है देर. It won't take time to change. You know, your fortune will change like overnight also it may change in very fast pace, then you can expect.
And it's so true because if you think about the market cycles that we've seen, and generally you talk about 3.5, 4-year cycles even.
Yeah.
But those cycles seemingly are getting scrunched. The time that they're taking to turn this way and that way are reducing in duration. Are you experiencing that as well?
Yes. So, and that's where if you have the patience, if you show the patience without taking too much of action, what happens is that the volatility gets even out over a period of time. So longer the period, that the volatility which you see in short period, which looks very sharp, very startling, over a period of time, it looks like a blip.
Yeah.
So
actually, to the point on SIP returns over the course of this last 1 year or 400 plus days, if people had continued with their SIPs, and we spoke about this in January, February this year, when the broader markets had fallen by 20% by February end, and then the recovery of 20% took place after that, and people who got out when the market had fallen by that 20% did not get to experience the very sharp rebound that came through after that as well. So though the point-to-point return for the benchmark will be more or less flat, there are chances that people who have deployed at the lower levels have actually made money.
Absolutely. And that's where, especially when you are a long-term investor, if you are a SIP investor, it makes sense to keep buying at different levels. And so if I have to give some example, so for example, September 99 to 2002, that was the period when there was total lull in the market.
Yeah.
Market fell down.
Dot-com
burst happened, and suppose if you have been you were doing SIP in say Sensex only, and after 3 years the SIP return was negative, I'm talking about a return in Sensex. I mean, investing in Sensex. It was around minus 4 point something. But if you continued for another 2 years, that number turns into magical some 17-18%.
Right.
From minus 4% to 18%. The beauty is, though the returns have gone up by almost four times or 5 times, the Sensex level, which was around 3,300 in December 2002, was approximately 6,600 in 2004 December. So it went up by 2 times, but your return went up by more than 4 times.
Because you use the time to accumulate units.
Yeah. So people call it rupee cost averaging.
Yes.
I call it unsung hero because it is least talked about the feature of an SIP.
So, but a lot of this has to do with what the crowd is doing. And there are so many great examples of this, even if we look at the stock market today, right? You see a stock that has gone up, say, 40, 50, 60%. And invariably, a lot of retail investors are the last to jump onto that bus. And as a result of which, when it starts coming down, they lose money, whereas everybody else has gotten off at that point. Yeah. I mean, we speak about herd mentality quite a bit. Yeah. What do the saints say about it?
So Kabir said that, mood mudaye hari mile, har koi leo mudaye. Bar bar ke mood se bhed na baikunt jaye.
Okay.
That by shaving your head, if you are going to attain moksha, then everybody should shave their head.
Right.
But the sheep, which gets shaved every year, does she go to the Vaikunt or she attains moksha? Answer to that question is no.
Yes.
Similarly, and this is the most common mistake people make across the world, is the following the herd. And this is a typical trait of a retail investor. So retail investors come into the market when there is, it is overhyped, when everybody talks about that, okay, this will go to whatever level they are talking about, and then they think that, okay, I have missed the bus. Now I need to catch up.
Yes.
And the expectations again that probably in 6 months' time I'll double my money, or 3 times double my money, 3 months double my money, and a lot is because of the so-called influencers who keep talking about how to make quick money in short period of time.
Yeah. So that is true. And in fact, it goes back to the first point that we were talking about, which is setting your expectations. Yeah. There's nothing wrong with a 12 to 14% compounded annual growth rate over the course of 10 to 20 years.
Absolutely.
Because ultimately, we're talking about 14, 15% every 6 years or so.
Yeah.
5, 6 years, you are doubling your money.
Yes. And secondly, to keep it very simple, I suggest people to look at, one is inflation plus 5% expectation. What is your objective of investing? To beat the inflation. Correct. Primarily to beat the inflation. Yeah. So inflation plus 5% over a period of time. It will not happen on day basis, but over a longer period of time, inflation plus 5%, or say nominal GDP plus 5%. That is good enough expectation from the market.
Okay. Now, there is also this concept of ignoring liquidity, and this happens when, again, kind of like what people experience when they go whole hog into equity, and they have very little to deploy when the market falls. In fact, this was a bit of a meme that was playing out on social media. Buy the dip, but with what money? Yeah. Ultimately, right? So because people had already deployed, they thought that the bottom had been found at 10%, but the market fell another 10%.
Yes.
Is there something here as well?
Yeah. So most important thing is people need to maintain liquidity for a variety of reasons. One of them, the most important in today's world, is there has been a lot of layoffs happening. So that's the reason one needs to maintain the liquidity. And in the financial planning terms, it is called as contingency planning.
Yes.
So Rahim says, Rahiman nij sampatti bina ko na vipati sahay, bin pani jo jalaj ko nahi ravi sake bachaye. It means that cash is the king, we say in English, right? So if you have
Indians
money,
have been saying that for a long time.
Yeah.
It seems.
So he says that you need to have hard cash in your hand because any casualty or any emergency, it comes without warning, right? It doesn't come by, yes, so it comes without warning. And bin pani jo jalaj ko, so lotus, right? So if there is no water underneath the lotus, it will, because of the heat, or because of the heat of the sun or the rays, it won't be able to survive. So similarly, for an investor, it is very, very important that he or she should maintain the liquidity in the portfolio, at least 3 to 6 months of household expense.
So and look, we've spoken about this as well, but 3 to 6 months in your contingency fund, that is very hard for a lot of people to do, and often the advice that comes from financial advisors like yourself are to build it over a period of time, but to prioritize that first when you're starting out, because that's the best thing to do. It gets you in the saving habit. But beyond that, my question to you is, we're also talking about at the portfolio level, because people tend to gravitate towards creating a physical asset very early in their career. They're willing to take on that mortgage because ultimately a lot of people have told them, hey, you need to buy a house, you need to go and you need to create a physical asset, even when they're not necessarily ready for it. What advice would you have here?
So again, very important question, very relevant in today's context. People have this habit of buying physical asset a lot, or insurance policies, the endowment policies, the traditional policies, where people get stuck in case of any emergency. Because if you have taken the loan, or if you have bought such policies, no matter how the financial condition is, you'll have to pay the EMI, or you'll have to pay those premiums, hefty premiums. And that's where it is important. And I always say that you should be hoping for the best, but you should be ready for the worst when you are investing, right? And the liquidity is the paramount. It should be the most important aspect of your portfolio construction, that God forbid if anything goes wrong, and if you are exposed to real assets, then it would become very, very difficult for you to run the show.
So what is a thumb rule? See, and it's difficult to do that because everybody's risk-taking ability is different, but there needs to be some ground rule about the amount of liquidity that you should have available to you. For example, in COVID-19, when the markets crashed, those people that had ready available money to invest benefited because they bought Nifty 50 at 7,000 odd points. And then in the span of 2-3 years, it tripled from that. So, but if you don't have that money to begin with, it can't come from thin air.
Yes. So that's precisely the reason that whether it is casualty or whether it is the opportunity, you need to have cash in hand.
So what's the rule though?
So a rule, I don't follow any thumb rule as such, but typically say 15 to 20% of your total net income, as in the CTC.
Annual CTC?
No. So total 15 to 20% of your take home, not more than 15-20% should go into real assets. Because why I'm saying this, because typically any youngster today, people who are in their age group of say 30-35 or between 30 to 40, more than 40% of the expenses are towards lifestyle expense. Right, and when I'm saying lifestyle expense, that includes sending kids to school, right? So and that becomes necessity, that you can't avoid those expenses. In that case, there has to be some provision for liquidity as well, and for these kind of opportunities when they hit. When they come your way, you should be able to able to deploy that money.
Where would you put it? You would put it in debt mutual funds. You would put it in arbitrage. Is there a preferred way that you would suggest?
I would prefer to invest in arbitrage or a liquid fund, for that matter. Instead of investing into debt fund, because debt also comes with some bit of volatility.
I meant that only. So the broad category of debt funds, you're choosing the lower end or the shorter end of the spectrum. You're saying liquid funds or short-term debt funds or something like that.
And again, I have a reason for that.
Which is?
So I say that when you are investing for a short period in a fixed income product, you should have one term in mind, and in that particular order is safety, liquidity, and return.
Okay.
So if the shorter end of the curve when you are investing, your safety is taken care of, and it also provides liquidity, and then followed by the return. Because there will be a difference of return by 50, 60 basis point, but that doesn't make too much of difference.
Speaking of returns, there are a few couplets that relate to enjoying the moment or enjoying the process that you told me about, and they're really beautiful. Can you tell me about that?
Yes. So people keep chasing the return, probably because of sheer excitement, or rather at times to flaunt that, say, hey, I have made this much of money. And the fact is, if you are not able to enjoy that money, then there is no reason to invest, right? And that's when Kabir says that कौड़ी कौड़ी माया जोड़ी जोड़ भरेला थैला कहत कबीर सुनो भाई साधो संग चले ना ढेला. It means you are penny wise pound foolish, or say penny you are adding to your portfolio, your corpus. कौड़ी कौड़ी माया जोड़ी जोड़ भरेला थैला. So you are now back full of gold, say, okay. कहत कबीर सुनो भाई साधो. So he's saying कि gentlemen, I'm telling you that whilst leaving this world, you'll go empty-handed. So why not to enjoy that money, right? Rather than chasing the
golden
returns.
words. And ultimately, I'm stunned by the fact that this wisdom holds through the ages, right? It's so true, and it is said in different languages. It must be said, right?
Yes.
Because you come to this world with nothing and you leave with nothing. It's what you do during that time frame that is the most important. So this is one thing, and then beyond that as well, to more or less just draw all of this to a close. Having a goal obviously is important, and saving towards a goal. Saving, you pointed it out, the fact that you should enjoy the journey and you're not saving just for wealth creation. This is an outcome. You are saving so that you can utilize that wealth for something, which is why one of the first questions I think advisors like yourself ask people when they say, I need help with my money, you ask them, what do you need it for?
Yes.
So what are the learnings that you can take from the saints that relate to this?
So important thing is your why needs to be clear on the day one. And if you are not clear, you sit with your advisor and get it clarified that why you are investing in first place. Secondly, whilst investing, it's a journey. So it will go through a lot of ups and downs. You need to have patience, you need to have discipline whilst investing, and follow that. Whilst following that path, you need to follow the discipline as well. It is very, very important. So any investment which you are doing, eventually you are going to enjoy that money, right? And for that, whilst setting the goal, sit with your advisor. And at times people have this habit of investing or asking that what is the minimum investment I have to make, right? And that's where you end up missing the goalpost. So Rahim says that Rahiman chhot naran so hot bado nahi kaam. So if you're looking at a larger picture, larger goal, then you'll have to invest larger amount also. For that, when you sit with your advisor, you can differentiate between need and want. So when you decide that, okay, this is my need, it means I'll have to spend this much of money, and if this is a want, I can,
do away with
this, and I can invest that money in the funds or in the asset class which have been suggested. So Rahiman chhot naran so hot bado nahi kaam. Madho damamo na bane 100 chuho ke cham. So rather than asking that question is, okay, what is the minimum investment required? You should focus on the goal, and if the goal suggests, it's like when you are chasing a 300 score in a one-day match, you'll have to take some bit of risk. You'll have to make one boundary at least in an over. So you'll have to take that kind of risk also. So the Doha suggests that Rahiman chhot naran so hot bado nahi kaam. It means the people who think small, they won't be able to do big in life.
Important message there. And there's also another teaching and several teachings related to action and related to moving away from procrastination and not waiting till. And look, this is true for for good advice, for health, for wealth, for everything else,
Yes.
right? The better thing is to start work, and in the context of your physical health, the advice is to at least show up.
True.
So is there a teaching on procrastination?
Yes, and a very important one, because whilst on the journey of creating wealth, the most important thing which gets ignored is the power of compounding. So Kabir says, "Kal kare so aaj kare so ab."
The most famous one.
The most famous, and in this school, probably we have made a lot of fun of this doha, that, but "Kal kare so aaj kare so ab. Pal mein parlay hoegi, bahuri karega kab." That you need to start today, or rather right now. This is the time. When people ask, many times people ask, what is the best time to invest?
Yes.
The best time to invest is now.
On that note, thank you so much for joining me today and for sharing those words of wisdom. And
Thanks for having me.
My pleasure. And you heard that. If you aren't investing and you're listening to this, start now. Let us know what you think, and do stay tuned. This is NDTV Profit.